Well, hello there, people, and happy Valentine's Day. Because I'll probably post this today, but it is Valentine's Day, at least of the day of this recording. But anyway, Bradford from Beacon Finance and Consulting here. And I've gotten a question about the reportability requirements for an HSA, a health savings account. And these, if you have access to it, are some of my favorite accounts because there's a triple, sometimes even quadruple tax benefit. You get a income tax deduction. You sometimes get a payroll tax deduction, the FICA tax, the Medicare tax, depending on how payroll processes it. The growth for the HSA is tax-free. So that's three. And then when you take the money out, if it's for reimbursement of a qualified medical expense, that's also tax-free. So potentially quadruple, depending on how you play your cards with it. So anyway, typically what this is for, if you put money into your health savings account, usually it comes through payroll. It's typically more advantageous if you can get it to come from payroll, but still you can also do it independent of it if you're eligible. And that's basically what this form talks about, contributions and deductions. If you make a contribution, you certainly want to file this form, otherwise you do not get a deduction on your tax return. However, on the other side, if you're pulling money out of a health savings account, you do need to go ahead and report that on here. Now, what you'll see is here's the total amount of distributions that go here. And of course, if you roll it over to another HSA, that's excluded. Qualified medical expenses are also excluded, which could easily get this down to zero. If it is not qualified and you're not reimbursing yourself for a qualified medical expense, that's a little trick. You can pay yourself back in time for previous qualified medical expenses. You are subject to a 20% penalty, so keep that in mind. And if you make contributions to a health savings account, you don't have a high deductible plan, that's basically what this bottom section is for. It's going to be pretty irrelevant if you didn't make any contributions to the health savings account in the first place. Now, something that I wanted to bring up is who actually must file. And so these are instructions. They're not tax code. Congress did not authorize this. However, the IRS will go ahead and mitigate penalty if you follow instructions and turns out the IRS is in error. It needs to be the IRS's publication, not some third-party publication. Just as a heads up from when that comes to play. But who must file? You must file Form 8889, which again is this form. If any of these apply, you, someone on your behalf, made contributions for 2024 to your HSA. So you make contributions, your employer makes the contributions, you have to file it. You received an HSA distribution, of course. You must include certain amounts in income because you failed to be an eligible individual during the testing period. And it's basically, I could make a whole nother video on that, but basically that means you did not maintain a high deductible plan and there's some proration that's at play. You over-contributed to your health savings account. You acquired an interest in an HSA because of the death of the account beneficiary. So somebody died, you received it. HSAs are very, very tax inefficient to be a beneficiary of. It's better than nothing, but like you just pay full income tax in the year that you receive it. So HSAs are certainly one of those accounts where it's good to have money in, but it's probably good to pull money from in the overall retirement schematic based on a tax perspective, because from the beneficiary standpoint, a large chunk of that's just going to go to the government in the year that it's received. So kind of keep that in mind too as you're going through this. So if you have an HSA from an old employer and it's just sitting there because you have title to it, technically you do not have to file this form. So a lot of third parties will try to get you to file this form, and they charge you money on the last screen. I always loved seeing that. But technically you don't have to report anything. But again, if it is on your W-2 as an employer contribution or you contributed, oftentimes it's lumped in as an employer contribution on your W-2, then technically this form is required. Pulled money out, it's required. You contributed, didn't maintain a high deductible plan status, it's required. Other than that, unless you meet these criteria, it is not required on your tax return, and you don't have to pay TurboTax extra money. Hope that helps. Let me know if you have any questions, and until next time, happy Valentine's Day.